Hey everyone, we've got a new episode of In the Money with Amber Kanwar, and something really interesting is happening in the markets. We know that tech has been a star performer in 2025, but in November, tech stocks are lagging, and Nvidia, the most valuable company on the planet, is not the best performing semiconductor company. In this episode, we talked to Shane Obata of Middlefield, a tech investor, about whether or not cracks are starting to form in the AI trade. Now, I'll spoil it for you. He thinks that there are still some legs, but you have to invest responsibly. And he points to the single factor that will actually undo the AI trade. As always, let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Shane Obata, thank you so much for joining me.
Thanks for having me.
I'm surprised you don't have more gray hairs because tech has been an insane roller coaster this year, and that's exactly the kind of kind of stocks that you invest in.
I do have them. You just have to look closely. But yeah, it's been a crazy year.
So tell me about the journey this year. I mean, I think tech generally is not for the faint of heart, but you're looking down the barrel, earlier this year of a bear market. Tech stocks plunge more than 20%. The Mag 7 does worse. And you're thinking what during that time?
I think in the moment, everyone's going to be upset and concerned. And there were reasons for concerns. There was on the tariff side, that really did feel catastrophic, what was happening. And I'll tell you, I didn't expect it to be reversed by just one guy saying buy stocks, but that's what happened. And then DeepSeek, that was another thing. We kind of digested that, I think, well. We wrote a piece about it, and it was basically to the extent of this is going to accelerate AI. As costs go down, people will use it more. It's going to accelerate the build out. But the issue with high-priced stocks is that all it takes is a narrative crack. So even though the fundamentals hadn't changed too much, the fact that the narrative was at risk sent tech stocks down a lot.
So how important is it for investors to understand that, when you're going to own these stocks, that is the risk? The risk maybe isn't to the fundamentals. It's to that narrative crack, which could really come in the form of a tweet. It could come in the form of, an article, one company missing. It's really easy.
I think it's the opposite. I think you want to learn to avoid thinking that way. That's more helpful to just know from a portfolio construction standpoint, you've got some value, you've got some safer things. You need to have some tech. It's going to move around a lot. But ultimately, I think one misconception about tech, it's perpetually expensive, but it's got the best earnings growth over time, right? And so that's ultimately what drives stock prices. And so even with high starting valuation points, I think investors should have some comfort that it's backed by something. And we might talk about frothy parts of the market that are kind of unhinged from fundamentals, but generally speaking, I think that's fair.
Well, let's dial into what you just said. Stocks follow earnings growth. This earnings season was a bit peculiar because their earnings growth was there. The Mag 7 as a group exceeded expectations. But in some cases, and we'll talk about Meta later, but let's use Meta as an example, the market didn't care. The stocks plunged anyway. And at least in November, the sector is lagging. So why is there times where you get this disconnect between earnings and how stocks react because it was already priced in? Or I don't know, how do you make sense of that?
Right now, I would say the focus is on capital intensity, right? And so what do I mean by that? I mean, roughly, if you look at CapEx as a percentage of cash flow from operations, that's one metric, but just think of it as how much are you spending relative to how much you have coming in? Revenue, CFO, whatever. So the market has become worried because of the scale of the build out. It's so massive and world changing, and people are scared. So, I mean, we can go case by case, but the most clear-cut example of these fears is Oracle, right? Oracle reported those crazy RPO numbers that went up mostly because of OpenAI.
What's RPO?
Remaining performance obligations. It's just like, think of it as like a backlog. So I kind of viewed that as, okay, we learned that it's mostly OpenAI, and I said to myself, okay, if I was going to bet on one AI disruptor, it's going to be OpenAI. They're by far the leader in terms of adoption. We can debate on if they're the leader in terms of technology, right? But anyways, the market didn't like the customer concentration. The market didn't like the negative free cash flow profile. And if you look at stuff like Oracle and OpenAI, we know they have to get through this negative free cash flow cycle. And that's going to last for years until the end of the decade, right? I think things will change as monetization becomes more clear. But the point is, like, right now, people don't want to bridge the gap. And that's why Oracle has been so weak recently.
Now, is that an opportunity? Do you like that? Or are you saying, no, you're right to be nervous about that concentration risk and exposure to OpenAI?
I think it gets solved. I think it's an opportunity.
I think you've hit on something really important and is becoming increasingly apparent. All roads lead to OpenAI. Yes. And the risk, they're talking about OpenAI when it goes public being $1 trillion company. When it goes public, remember a unicorn used to be anything over $1 billion. So we'll have never seen anything like that. And I wonder if the risk is not that it happens, but if it doesn't happen, right? Because OpenAI is losing billions and billions of dollars. If for some reason it loses its ability to fund itself or people who are willing to finance it, a lot of things fall apart.
You're answering the question. So what does OpenAI need the most?
Money.
So they're going to IPO at some point, right?
And if it doesn't go well, this is a problem.
Yeah, it has to go well. So when you think about the overarching AI build out, trade, sustainability, we need to see rising adoption until the money starts cranking, right? So let me expand on that. 800 million people use ChatGPT weekly. That's
a lot.
That's insane, right? That's a huge proportion of the entire world. So it's already become fully mainstream. They're going to figure out other ways to monetize, but right now it's just building dependency. I don't know if you want to talk about what kind of tools you use, but I am fully dependent at this point in my process at work, even researching, helping me with automation work. It's just, I would pay a lot more than the free tool that I use right now. If I had to.
I'm using it every day and I'm finding new ways to use it. I'm experimenting. And we've talked about this in the past, but what that means for Google. And I thought it meant, well, Google's over. And like an idiot, I sold it because I let myself be scared of that threat prospect. And what did Google do? It just went on to make all-time highs. How do you think about if 800 million people are using ChatGPT every week, what does that mean for search? How often are you Googling something versus ChatGPTing something?
I still use Google all the time. I too got caught up in the disruption risk which is frustrating because you probably remember me as being like one of the bigger Google bulls that I knew. And I got scared by the ChatGPT threat. So we're still participating in Google, but not to the extent that I would have liked. 600 million people monthly are using Gemini. That's also a pretty incredible stat. So,
that's Google's version
Google's
of AI.
So look, they have all the pieces to the puzzle, which we identified a long time ago. That's a science company, first and foremost. Okay, let's think about it that way. There are a bunch of scientists over there. Demis, the guy who runs DeepMind, is a Nobel Prize winner. Like he's a scientist. So they had the research talent, they had the distribution, they have the customer data. It's all there. Like I think with AI, you want to have channels through which you can let people use your AI, and they have tons of that. They have YouTube, they have their search data, everything connected to our Google accounts. So I think they're well positioned, but I do think the ChatGPT risk is going to reemerge. But thus far, it hasn't impacted Google's financials.
How does this? How do you? What's the word? I'm doing it not safely. How do you responsibly allocate for AI in your portfolio? Because as you said, it's such a game-changing trend. It is hard to fight the trillions that are being poured into this sector, but we all have the same fear about it either not showing up or it blowing up in some way. So how do you responsibly reflect that in the portfolio?
The simple framework that we've used thus far. So let me start off. I'll give you a nice framework here, simplistic framework. So if we look at the cloud computing market, it's basically like a triangle, and at the top you have the smallest part would be the top. That would be like the hardware. In the middle, you're going to have a wider part of the triangle. That's going to be the platform infrastructure layer. And then at the bottom, the widest layer is going to be software. So that's kind of where AI is expected to go over time. And that kind of coincides with my three phases of AI, which would be semis and hardware, 1, 2, infrastructure, 3, software. So how do you?
Aren't all the phases?
No.
No. Okay.
No,
where are we?
Let me get there.
Okay.
So how do you responsibly allocate? Follow the money. That's what we're doing. Follow the profits. Let's not talk about like where might the profits go. So that's why software is so difficult, right? Because people are looking around, thinking about disruption, thinking about changing business models. These, like OpenAI has become the new Amazon for disruption risk. You know what I mean? So that's tricky. So follow the money, right? And for me, if we adjust that phase 1. So phase 1, I said semis and hardware, but phase 1 could have arguably been just Nvidia, right? And then I thought maybe with the Oracle and the clouds accelerating, maybe we're moving to phase 2. I think that was wrong. So I think actually we're moving to 1B, which is hardware. You're seeing the bottlenecks in memory and storage. Networking stocks are doing really well. Like that's where we're at. So I think as opposed to trying to predict where things are going to go, kind of just following along and following the profits.
Does that mean, I feel like people want to get so cute about Nvidia and they're like, no, there's just got to be another idea. It's too discovered. It's too over-owned. What do you say to people who are like, I want to move on from Nvidia? We had a guest on a while ago who said the next Nvidia is still Nvidia. That's
a good quote. I mean, there's some nuance there, but they're the number one winner from AI thus far, right? It's not even close. Like the companies buying the chips are the ones that we're seeing hit with concerns about what the return on capital is going to be from these investments, right? So that's not that's sort of their concern in terms of sustainability of this build out. But look, they're still the leader by a long shot. I'm sure we'll talk about AMD at some point and Broadcom and the ASICs players, but Nvidia, even at around 30 times forward multiple, is not expensive given the earnings growth rate.
That actually segues us nicely into the mailbag. Let's get into that. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, actually, our first question in the mailbag is about AMD, which just held its analyst day and really did its best to say, we're here too. It's not just Nvidia. We're going to grow our sales 35%, for the next 3 to 5 years, 80% in data centers. So Simon on Instagram wants to know, is AMD still a hold? I bought it at double digits and not sure if I should sell it. I think the stock has more than doubled this year.
I'm not sure on the year-to-date return as of this very moment, but I think AMD is actually going to play a part now. So we haven't been there for a bit, and I'll give you a bit of background. But on AI semis, when we looked around the landscape, we quickly discovered or came to the conclusion that Nvidia was going to dominate GPUs. Now, we also had the view, which proved true, that ASIC providers, basically custom chips providers, could coexist with Nvidia while not directly competing with them. So unfortunately for AMD, which I actually do like, and we can get into the whole thing if you want, but I've always kind of liked them and their management. The story used to be about them taking market share from Intel and CPUs, and then CPUs are like the brains of the computer. And then the GPUs are more graphics oriented, and then they have AI applications. So that's the distinction. But that was the core thesis on AMD a long time ago, taking share from Intel, which they've continued to do. But then all of a sudden, GPUs just exploded. And so the market was then GPU versus CPU. Anyways, I'm rambling. So
this is like, people will hear these acronyms and not know what it's about. So
stop me whenever.
No,
I try not
it.
to.
I'm learning.
So that was the thing with AMD. I didn't see how it fit into the picture because they were trying to compete with Nvidia, and when you try to compete against Nvidia, you are probably going to lose. So, but things have changed. So what's changed is they potentially have given away 10% of the company to OpenAI.
All roads lead to OpenAI.
All roads lead to OpenAI and Nvidia. This is true. If either of them falter, we're going to have problems. That's not happening yet, so thankfully. So yeah, back to AMD, they do this deal with OpenAI. They basically give away their Instinct processors. I think it starts in the second half of 26, and they're going to deploy 6 gigawatts. And as it's tranched, so meaning that OpenAI's equity, their ownership of AMD will increase as that is deployed, if it's deployed all the way. So why is this interesting? It's interesting because people have long said that, and a key part of NVIDIA's moat was the software, right? The CUDA software system that everyone uses. And AMD's software system was just not as good. And so when I saw this deal, I was like, good, honestly, because this is a way to say, use our stuff, and then maybe you say it explicitly or you don't, but they're going to help you to optimize your software. The same kind of stuff that's happening with Anthropic and Amazon. Anthropic is helping Amazon to optimize their chips. So it's the same kind of thing. So anyways, given that, and given now at the scale of Nvidia and where we're going on the power side and all of that, like, can they play a part? Can the cookie crumble?
Mm-hmm.
Can they get some of that? Yeah, sure. So
Well,
I think you can hold it, but they're not going to dominate, but it seems they'll play a part.
So here's what I'll say about that.
Yeah.
And this is, I imagine you're going to think this is an annoying comment, but I'm going to say it anyway. Okay. In 2025, AMD has outperformed Nvidia. Intel has outperformed Nvidia, even as Nvidia is, by all accounts, the better company. So how do we explain? And of course, over the long term, Nvidia has just crushed these players. But it is interesting when other laggards start to outperform the dominant player. And what does that tell you? And do you follow that trade?
It tells you the people coming back to the onset of, please let me buy anything that's not Nvidia, which is just, it remains the wrong way to think about it. But people are looking for the next thing, which is right. But as I said as I said earlier, in terms of following the profitability, who's actually going to do well? We're going to find out.
Rank order your favorite chip stocks, your top 3 chip stocks.
That's tough at the top right now. I would say Nvidia has to be number 1, and then maybe a tie between Broadcom and TSM. Those are the ones we've liked for the longest, and TSM's been great this year.
This is Taiwan Semiconductor.
Taiwan Semiconductor.
And actually, we have a question on that, so that segues beautifully. A previous guest said you can't go wrong with Taiwan Semiconductor as an AI winner. What are your thoughts? Do you have any concerns about China? This one coming from Ian on Instagram.
We're always going to have to worry about China, unfortunately. But what they're doing to build out their capacity in the States is good. And so if we think about Taiwan Semi as having an R&D center basically in Taiwan, that will be the core of it. That's going to be the bleeding edge technology, meaning, in other words, like the smallest nodes, the most advanced chips will always be in Taiwan as things stand right now. And so if we think about what's happening in the States, they're going to be one generation back, but still advanced chips. So we're going to be able to produce Nvidia chips in the States, AMD chips, some Apple chips. And so I think that's helping to reduce the risk in the name.
Okay, so that's interesting about Taiwan Semi moving into the US and the extent to which it de-risks the situation with China. And if you're not familiar, there's always this fear that China invades Taiwan. And that is seen as like the red line of all red lines. And it would be very destabilizing to the whole technology supply chain because so all roads also lead to Taiwan Semi. So to what extent do you think, bringing some of that to US like de-risks that a little bit?
It does, not all the way, but it helps. But yeah, you said all roads lead to Taiwan Semi. I mean, this was a pretty simple story for us. I mean, in terms of, you look at their clientele, they sell to Apple, they sell to Nvidia, they sell to Broadcom on behalf of Google and some of Broadcom's other clients. So it's just, they're really benefiting from strength in the AI market, and then the long-awaited upgrade cycles and smartphones and PCs, maybe those actually start to manifest, and that could help TSM too, but still a great company.
And like 28 times earnings, that's all a China penalty, is it not? Or a China risk?
That's probably last 12 months, right?
Yes.
Okay. Forward's even better. So
okay.
Don't worry
about it. All right.
No, it's not bad. It's not too expensive.
So we've talked about companies that are going to do well with AI. I think the jury is out on Salesforce. And this is one that you could maybe get cute with because you're looking for things that are down and dirty. Salesforce is one of them. Ruhan has a question. There are concerns about Salesforce, but the company recently offered a strong forecast. Do you like the stock?
I want to start with a question to you. So when you think about Microsoft, what do you think? What is Microsoft to you? Don't think too hard. Just
like PowerPoint.
PowerPoint. Okay, but like what group does it fit into?
Software.
Okay, software. Good.
Yeah.
So the reason I asked that is like I think, at least in my mind, sometimes I just think of the Mag 7 stocks as, these world-beating companies, but Microsoft, as you mentioned, is the world's best software company. And so especially when the software industry is very challenged right now, everything should be benchmarked to Microsoft. And so should you own Salesforce? The answer is no, not if you can buy Microsoft. So maybe that's lame, but okay, we can get into the CRM specific stuff.
No, I don't think that's lame. I think like if that's your answer, sometimes it doesn't need to be
complicated.
It doesn't need to be complicated.
CRM, your guest, your writer, however you want to call it.
Our viewer.
Your viewer, sorry, that's the word I was looking for. They're alluding to the 10% revenue growth target that Salesforce put out. We'll see. I don't really believe it. So Salesforce, when people think about Salesforce, of course, they think about the CRM product, which is the client relationship management product. Most people have heard of it, used it, whatever. The company has done a good job diversifying away from that. Customer service, marketing, platform, which is basically providing a platform upon which to build other things. Now, the issue I would have is you're up against Microsoft in certain areas. So you're up against Microsoft in the CRM space. You're up against Microsoft in the platform space. You're up against ServiceNow and some of the other segments. And so I'm just kind of worried about competitive threats with Salesforce. And what else did I want to say about CRM? I'm not sure. Part of that story was, okay, we're gonna reaccelerate this business and grow margins, and they've done well on the margin front, but are they going to stop doing big deals? I don't think so. I mean, they'll say that, but then they're just going to keep doing them because they want to. Is
that a bad thing? Sometimes the market loves an acquirer.
I think it speaks to perhaps an inability to build awesome stuff internally. It's a very high level view. I have no position in Salesforce, so I'm just offering my high level thoughts, but worried about competition, worried about what they can do internally. And then like the AI opportunity, I'm not sure how big it is as a relation of their whole business right now, but it's very small. And so imagine they come to your podcast and say, you have different software vendors coming in to pitch AI. How far down the list is Salesforce AI going to be for you?
Yeah.
Pretty far.
Yeah, because I'm not on anything.
Yeah.
Microsoft's already got its tentacles.
Right. I mean, that's the natural thing. So I'm worried about competition. I'm worried about them doing too many deals. I'm worried about AI disruption for sure. So I just think this is one I'd rather wait to see them inflect and then take a look at it.
Let's talk about Meta, which is the next question we have. Thoughts on Meta? Is there still upside? This one coming from M. Nanda on Instagram. You can now buy Meta at like a 4 or 5 month low. That's a rare opportunity. And this is like one of the rare companies that is beyond picks and shovels. They are deploying AI. They're seeing returns from AI in addition to spending on AI.
Correct. So when the Apple privacy changes happened, which basically ruined Facebook's targeting, they used machine learning, which used to be called statistics and is now called AI. So it's all statistics. But anyways, they successfully used that because they had to fix their targeting. And so they're the most clear-cut, one of the most clear-cut examples of AI return on investment. That being said, the issue with Meta, like Oracle, is the capital intensity. And the problem specifically with Meta is they don't have that other thing. They need the other thing. What is the other thing? So Amazon has AWS, okay? Microsoft has Azure. Google has Gemini. OpenAI is its own beast, but they're dominating in the subscription market, consumer subscriptions. Anthropic's dominating in enterprise subscriptions. Like, where do they fit into this picture?
Like more than half the planet is addicted to their platforms.
Right. Okay, but
Is that not enough?
No. Here's why. Spending to make your core business better, which it clearly is. Anyone who's been on Reels, if you haven't thought about setting a time limit on your time spent, like I've done, then you should do that. So it's you can see it working, okay, in terms of the engagement and all that stuff, and it's helping on their advertising stuff too, with people using them for advertising. They're using automation there, but they're spending money like they want to win AGI, which I think Zuck does. He wants to win AGI. AGI is artificial general intelligence, or just think of it as like the singularity moment, like the God model, whatever you want to say, when it's like gets to the point that it's like
it's in you.
It could dominate society. Like that's kind of the idea. But something that is just smarter than all humans and all things, I guess, is basically a very loose, weird way to put it. Anyways, they're spending like they want to win that race. And so Google's in the race, OpenAI's in the race. Anthropic's in the race. Like, they need a thing. They need a shiny new object. And I think they have 6 months to deliver it, 5 months.
Beyond their platforms and just like monetizing the heck out of it.
The last quarter, the forward quarter guide implied a deceleration in revenue growth to just under 20%. 20% is still amazing for a company of Meta's size. But as soon as we got below that 20 level, people were like, wait a second, you're spending all this money. Mm-hmm. And Zuckerberg was asked on the call, like, what are you doing this with? And he said similar things to that the cloud companies said. They're capacity constrained, they need more compute, et cetera, et cetera. But it's all tied to the core business. I'm telling you right now, they need a shiny object. I don't know what it's going to be. They're smart. They'll probably figure it out, but they need something that's going to catch people.
So you wouldn't buy this dip here?
No, I think it's cheap. I'm giving you the overarching view.
Okay, so that's why it's down.
I think it's good value here.
Yeah.
But if they don't have this new thing soon, they're going to have a big problem.
They're not like Apple. They tend to find the new thing. They have a history of finding the new thing.
Are you saying Apple does or does not?
Does not. Apple is still iPhone.
Yeah.
iPhone all the way.
The funniest thing about Apple right now is Apple outperforming. The joke changes month to month, right? A few months ago, it's like, Apple sucks. They don't have an AI strategy. Haha. Now it's like, haha, their AI strategy is not to have one.
Yeah.
So it's low capital intensity. So it's the safety bid. Anyways.
So is that how you think about owning Apple? As like it does well. When you talked about like tucking some value away in your portfolio, we can argue about if Apple is value, but tucking away something that doesn't implode, if AI doesn't turn out to be what it's supposed to be, is Apple a nice safety?
Apple is a safety trade, 100%. It is on the other end of that spectrum of Oracle and Apple, right? Oracle, most capital heavy of the group. Apple, most capital light in terms of the AI spend. So look, it might actually turn out that they were right all along. Let other people spend the money, use their technology. They're partnering with Gemini and whatnot for what seems to be an unreasonably low price. But anyways, safety trade, very expensive. I just have better ideas than Apple, but it's a consumer staple.
We're going to find out what those ideas are in Pro Picks, but you have to hang on a little bit for that. We have a few more questions in the mailbag. One, you mentioned like who has shiny things. Amazon is one of those companies that for a while it was flat for 2025. We've got a question from Roche on Instagram. What is your opinion on Amazon Web Services in particular? And I think, correct me if I'm wrong, the concern was like, yeah, they've got cloud, but do they have enough AI cloud? And is that going to help recharge their business?
So the last quarter, they had 20% growth for AWS, which is the best in quite a while. Now, let's remember AWS was the first and the biggest, but recently the concerns around AWS were losing share to Microsoft and Google. And I guess Oracle, smaller, but Amazon is great and AWS will be fine. If we think about, again, every quarter it's the same thing, and until this changes, I'm not going to be that worried. Every quarter they tell us, the big players, we do not have enough capacity to fulfill demand. So the reason Amazon was so bad this year was because we were seeing inflections in other areas, other cloud service providers, and they were kind of just left in the dust. So that had all these questions like you were mentioning. And so we felt into this quarter that they were capacity constrained. And they have a big relationship with Anthropic, which is doing very well in the enterprise, by the way. It seems like they are winning enterprise AI, which is very cool. And so we felt as though when that capacity came on to support Anthropic and their other clients, we thought that AWS was going to inflect higher. We weren't sure that it was going to be this quarter, but we're happy to see that it was. So AWS is going to participate in this. It's going to grow more slowly than the others, but it's going to participate. So we really like Amazon right now. I think it's a pretty clear-cut story in the sense of participation in AWS, highly profitable business, AWS, also in advertising.
And also OpenAI is using AWS. Like if you're wondering where they just struck a huge deal with OpenAI.
Yeah. So I think you'll see more of that. You'll see everyone using everything, but yeah, certainly that would be validation. So Amazon is a good story right now.
Let's talk some Canadian stocks.
Okay.
Obviously, we're going to talk about Shopify. Okay. What else do we have in Canadian tech? It is the dominant player. Do you like Shopify?
Shopify and RBC are basically tied for number one. I checked today, 290 billion market cap. So that's pretty cool to me because I'm a nerd. Anyways, Shopify, let's start off by saying very expensive stock. I think
always is.
Right. So I think it was 15 times forward price to sales. So we're starting with a price to sales metric. You know, it's going to be rough. They're doing a great job. They kind of dominated SMB, small, medium-sized businesses. They're moving to enterprise. They're growing more fast and they're growing faster in international markets such as Europe. And payments has really grown. The adoption of payments has really helped them as well. So I think if they continue executing, the stock does really well. And on any missteps, they're going to get hit a lot. Like I remember seeing, this is the kind of stock that misses by a little bit and will be down 15%, 20%.
Do you own it?
Just a little tiny bit because it's scary. But it's a good company. They're doing a great job. It's very impressive what they're doing. And I think I'll be a chicken about it. I'll wait for those miss hits and then consider buying more. But yeah, it's insanely expensive.
Okay, let's end with Constellation Software, the other big Canadian tech company. It is putting in rare underperformance. It is trading at the lowest level in more than a year. It's down quite sharply in 2025. Mark Leonard has stepped aside for health reasons. The stock's down 24% in 2025. And this was like one of those magic stocks that basically always went up. This is not going to be that year. And of course, this is the year that I bought it. So I'm curious how you think about Constellation Software. First of all, why is everyone panicked about it right now? And is there a path back.
So it's your fault then.
It's basically my fault.
You sent the stock down.
I did that, by the way, with Dollarama too. Dollarama's gone up every single year except in 2018 when I bought it and it went down.
Okay. I think there's overarching, I don't know if we really talked about the overarching questions around software in general, but if you think about something coming back to Salesforce, if you pay tens of thousands, hundreds of thousands of dollars for software and you're not using it to the full extent for whatever reason, then naturally you're going to wonder if you're paying too much money. And so that question mark is kind of like, is the seat-based model, paying per seat for an annual subscription, is that the right model? Like for the client, probably not. For the client, maybe shouldn't it be tied to my consumption? And tying to consumption, that brings about more volatility. Like software was always high multiples, high visibility, high margin, and recurring revenue, right? And now I think that question is going to continue persisting. Do we shift more towards consumption models? Do we shift more towards value outcome-based models? And so that to me means lower multiples. Then we have AI disruption risk. So there's a couple kinds of AI disruption. I will get to Constellation, I promise. There are a couple kinds of AI disruption risk. One would be like do it yourself. So that'd be like Amber, like, okay, I'm going to rebuild Salesforce myself. I think that's overrated as a risk because it's interesting to think like you can build something, but then you got to maintain it and update it and integrate it. So like people don't think of those other costs and complexities. So that risk is maybe overrated, but what's not overrated is like OpenAI or one of these startups making a better tool that's way cheaper. That is totally possible. And so that also potentially means lower multiples. So I think some of that stuff is weighing all of software down. This is probably the wrong way to think about it, but it's just a thing. Okay. Berkshire, since Buffett announced that he's going to leave, has underperformed. This is probably a similar situation. So I'm not saying that's warranted, but I'm saying that's sort of an analogy that makes some sense. And then, yeah, it's my personal opinion is they built something that is bigger than Mark Leonard. And I think that's what he would have wanted, something that's resilient and that will continue to work. So I think you're fine with this thing over a long period of time. Maybe you have to trudge through these questions, but it's a pretty devout shareholder base too. So I think there's only so long it can go.
Well, I'll got a good model. When I sell, because that's when it'll start to go back up.
Please do.
I will let you know. So are you nipping away at this? Are you holding on?
I'm holding.
You're holding. Yeah. Okay. Before we get into pro picks, one of the things that is kind of the big elephant in the room, you keep talking about supply constraints, capacity constraints. I mean, that's all power. And I feel like a lot of people don't think or can't fathom the amount of power that is needed to fuel these data centers. And are you there at all? Like in that layer when you talk to it's hardware, then it's, how it's being used, and then it's software. Like where does power fit into that? Is that your wheelhouse, or is that not really where you trade because of your fund's mandate?
We're doing a lot of work on power from different angles. So, pardon me, I would say when you're thinking about large scale, where does the power come from? How does it get to the data center? That's on the utility side. When you get to the data center, how do you get the power in the right format into the data center efficiently? That's where the industrial companies come in. And then once you're in the data center and you're moving to the racks, then we're talking about technology companies that specialize in power applications. So yes, very important, very important. I think it's the most important theme next year.
Is the power companies.
Power in general as a theme is the most important theme, I think, next year overall. So we've seen again, like they tell us every time that they're capacity constrained, they're also telling us there's power issues, right? And so it was interesting with Microsoft. I'm sure you remember, like, there was that period where the sell side was like, they're slowing down.
Mm-hmm.
What they were doing was passing the torch to Oracle, so that's fine. But now, because they slowed down a little bit at that point, and they need all this capacity, now they're signing all these deals with these neo clouds and crypto mining companies that have
IREN is one of them.
So I think that tells you enough. It's basically for the power. Do
you own any of them, or is it not in your mandate?
It could be. I'm not sold that standalone these are necessarily good businesses as they're currently operating. I see the value in time to power and being plugged in already and from the facility level, but I just haven't wrapped my head around the that part of it yet. So that's not exactly where I'm looking in power. Maybe I should be, but not right now.
Okay, well, let's find out where you are looking and get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first idea is Samsung. Tell me why.
Samsung, I don't know what they're best known for. Maybe TVs or phones. Phones are important. So they have their division of devices, I'll call it that. Smartphones, tablets, appliances, etc. They also have a big semiconductor business that's very heavily tilted towards memory. And I know you like memory. And so the memory market is just in a massive crunch right now partially because high bandwidth memory, HBM, that's used for GPU AI applications, is kind of taking up supply of DRAM, which is a kind of memory. Yeah. And so that's making the rest of the DRAM market really tight. And so actually, it's ironic, like HBM is the thing that everyone talks about, but Samsung actually might make more money on the commodity. So these are like memory supporting servers and server CPUs and other things, just more conventional forms of memory.
Stock's already up almost 100% this year. Yeah. How much more upside?
I think we have like 40% upside. I think we're around 11,000 Korean won of EPS fiscal 2026, 13 times multiple. Price target's like 143,000. So that's, call it around 40% upside. So yes, it's moved a lot, but the earnings estimate revisions that I'm seeing right now are some of the most insane things I've ever seen. So
and 13 times earnings, like what is that? Why so low? Is it because it is an international?
Some people will look at the memory stocks on price to book. So I'm looking at it on an earnings basis. Mm-hmm. I think given that we're potentially in a super cycle here, it makes sense to view it through a different lens. Maybe I'm reaching a little bit, but that's kind of how I'm thinking about it. What were we getting back to? Oh yeah, the earnings revisions. So here's a good data point. Since 3 months ago, fiscal year 26 earnings estimates are up 25%.
Wow.
3 months. And memory prices are going up like every day. So
and that's just on the supply demand dynamic.
Yeah, that's right. It's very tight for some of those reasons. And then we talked about DRAM. NAND is kind of the other side of it, and NAND is a component in solid state drives, which are like more expensive storage. We're getting a little off topic, but I just think it's important. So the most cost effective form of storage is hard drive disks, which are like actual physical moving parts and whatnot. And those are sold out into for WDC. They're sold out into 2027. And as a result, people are paying up for the SSDs, which is, again, tightening the NAND market.
What is that? What is that? SSD? What is
solid state drives?
Okay, yeah.
Hard drive disks, solid state drives. Yeah. Solid state drives, more expensive. HDDs, more cost efficient.
But sold out.
These are sold out.
So you have
to
buy
these.
Okay.
That's leading to tightness in the NAND market. And so now you have tightness in DRAM and NAND. Whoops. And so that's basically it. It's very tight all over the place.
You know, I love memory because I've been a loser on Micron until I wasn't. And now, what a genius I look like.
Now you can retire. It's
now
great.
I can retire. Well, no, not my $4 that I put into it. Okay, number 2, Take-Two Interactive. Grand Theft Auto, we're playing video games?
I think, I'm going to show my nerd again here. And my wife will hate this part, but I think video games are arguably one of the best value in the entertainment arena. So of course there's lots of competition for attention. We talked about Reels. That's a really tough one to get away from. But video games are more active. They're not passive entertainment. It's more active. But you spend $80, $90 on a game, you could play it for hundreds of hours in some cases. That's a lot of good value. So Take-Two, let's talk about the bad stuff first. So they delayed Grand Theft Auto 6 again for the second time to November of 2026. We were disappointed, but the core business is actually firing on all cylinders, driven by the 2K basketball video game series. There's more to the business. There's some mobile in it as well. But the whole story here is really about GTA 6, which we think will be one of the biggest entertainment properties of all time. So yes, the delay sucks, but we think taking the time to polish this thing that's taken such a long time is really going to pan out for them. And so we're looking for for fiscal year 28, which would capture the full year of GTA, we're looking for $12.68 of earnings at a 25 multiple. That's 317 price target. So that's, call it 35% upside.
Trading at around 240. And what a hot space. So a couple of years ago, Microsoft buys Activision.
Oh, yes.
Activision Blizzard. And then end of September, this Jared Kushner consortium, I think it was with Silver Lake, they buy Electronic Arts. So even if you want to play this in the public markets, where else can you go but Take-Two? Yeah,
it's a good point. You could buy Roblox, but let's not talk about Roblox. I think that stuff highlights the value in the space. And again, it comes back to the value provided for consumers. But I think it's a good business. It feels like it's on the upswing. Feels like the younger generation is very into gaming. And I don't know if this is a hot take but I think it's interesting with all these streaming people on YouTube and all these other platforms that are playing games. I think that helps the whole industry. So I think that's a good backdrop to release GTA 6 into, because it's going to be all over the internet for a long time. It's going to be crazy.
I love this. We are looking for ideas outside of Nvidia. These are, different takes. So we had Samsung, we had Take-Two Interactive, and now your third one is Alibaba. There's definitely an AI play there. But talk to me about why this one has become interesting to you.
I think there's a regime change in China. So in the post-COVID period, if you remember with Jack Ma having some issues with the government and then disappearing, and me being concerned for his whereabouts and whatnot, now he's back. He's back at Alibaba, in the office working. I think that's a really important signal because And the US and China are taking very different paths towards AI. I would say the US is let's build that God model that we were talking about before. China's more how can we use AI to immediately impact industries and robotics and automation kind of stuff. So two different paths, but you got to respect China as a competitor. As we saw, just even the DeepSeek threat really hurt the market. But the point being, with the regime change, the government knows that if China wants to compete on the world stage, they need to partner with and enable their companies. And so China needs a domestic cloud champion in the same way that we have the cloud champions in the States.
And Alibaba it's not gone on to make new highs. It's still like half of what it was, for example, in 2020. Is that the opportunity that's an undervalued play?
I think it's undervalued. I mean, I think part of that is what I was saying. It was sort of China tech was in the uninvestable bucket because of the meddling that was going on. But now it's like, we need each other. We need a domestic cloud champion. Alibaba's cloud business is still small relative to the whole business. Of course, most well known for their e-commerce offerings in China and other places. But we think all indications would be that they're going to continue accelerating with their cloud, and that will be enough to take the stock higher. And it's not expensive either.
We actually got a question about this from Sam Trottier, who asked specifically about Alibaba and its exposure to China, and why not, if you're, look at demographics or trends in Latin America, why not buy something like a Mercado Libre instead that maybe doesn't have the issues that China does?
I've nothing necessarily bad to say about Mercado Libre. I just think this story, China specific, made sense to me because China is somewhat of a closed market, right? And so they need a domestic champion. They need an AI champion. Alibaba's got really good open source models. Like, you might argue that they're the best overall in the open source world, which is pretty crazy. And then they've got the cloud business. They're kind of trying to build like a full stack solution. So they're offering they're making their own chips. They're going to have cloud. They're going to have software. So I think it's a compelling thing. So I'm not necessarily thinking about the relative geographic regions. It's like these picks were not like, I need something in Korea and I need something in China. They just kind of make sense.
Okay, and since you have price targets for the other two, how do you think about the upside that's left in Alibaba?
It's still very undervalued. And I'll say that this might be a conservative case, but we think they're going to do 1060 in EPS for fiscal year 27. Even at a 21 multiple, there could be some argument if that's high or low, but I don't think it's that high. If their cloud division really takes off, that gives you a price target of around 218. So plenty of upside, maybe conservative as well.
Trading at $160 per share. So definitely. All right. Thank you very much, Shane. It's been an absolute pleasure.
Thanks for having me.
That's Shane Obata of Middlefield. And you heard him say that he thinks power is going to be the big story of 2026. Our next episode, we've got one of the biggest energy investors in the country joining us to talk about the energy sector. David Zybunka of Canoe Financial will be our guest. And as always, if you want him to answer your questions, email us at questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.